Today on InvestTalk, we covered all the outflows coming out of China, summed up the market today and covered what happened this week, answered live caller questions on tickers IIPR, TRIP, and CCL, and then ended the day talking about what beneficiaries can do with an inherited 401k.
This is InvestTalk. Independent thinking, shared success.
Let's keep things moving and get right on to our main focus point today, which is about China, and more specifically, record capital outflows. Now, China's financial markets saw a massive exodus of capital in November, portfolio investment outflows reaching a record $45.7 billion. And this marks the largest monthly deficit on record, according to data from China's foreign exchange regulator. The outflow comes as Donald Trump's presidential election victory sent shockwaves through global markets and weakened investor confidence, which pushed the yuan ever lower. And so despite Beijing's efforts to stimulate the economy, concerns around new tariffs, a revitalized trade war, and China's ongoing property crisis have really kept investors away. In November, cross-border receipts from portfolio investments totaled $188.9 billion, while payments reached $234.6. That's a steep rise from October's $25.8 billion outflow. On top of that, the weakening yuan combined with the stalled growth and deflationary fears have really dampened enthusiasm for Chinese stocks and bonds. Foreign investors also reduced their holdings of Chinese onshore bonds for the third consecutive month, and data from the Institute of International Finance really supports this trend. It's showing that capital outflows from both China's bond and stock markets continue to increase. Meanwhile, Goldman Sachs reported $39 billion in foreign exchange outflows for November. $39 billion, up sharply from just a month before it was $5 billion. That's a sharp, stark increase. Now, much of this activity is linked to China's Stock Connect program, which allows foreign investors to trade mainland shares through Hong Kong. But as uncertainty about U.S. policy grows, understandably, investors have been pulling funds out. And so that's contributed to this surge of yuan outflows. Right, this fall of demand for the yuan. Now, obviously, when things like this happen, countries don't just sit there, right? China's leaders have promised to act. At last week's Central Economic Work Conference, they pledged to increase government spending, higher debt issuance, and looser monetary policy to try and stimulate not just domestic demand, but stimulate foreign interest. But that doesn't always work. Oftentimes it's too slow. It's not swift enough. And the overarching issues that China is facing, property crisis, trade issues, potential US tariffs, those are still looming regardless of any stimulative policy that the government puts in place. With Trump's return to office likely to bring renewed trade tensions, China's markets, regardless of what they try to do, faces significant headwinds. And so because of this, whether Beijing's stimulus can reverse this trend, it remains to be seen. And when you have that level of uncertainty, when you have that level of downside risk, investors need to play it safe, right? They need to move their money elsewhere. There are other areas of the world, though the US stock market has done much better than them for the recent past. There are other areas of the world where growth is better, when there are less concerns. And so for now, for the largest section of the emerging market index, it seems that the problems that are facing China will continue to lead to investors, not just domestically, but foreign investors as well, taking their money out. Stay informed and stay empowered by visiting investtalk.com today. Let's talk about the market today. Definitely a reversal from yesterday. U.S. stocks were generally higher. The Dow up 1.18%, S&P 500 up over 1% at 1.09, NASDAQ up 1.03, and Russell 2000 just missing that 1% mark, up 94 basis points on the day. The S&P posted its best session since the 6th of November in that post-election rally, though still saw a moderate weekly decline after the activity that we saw on Thursday in the wake of the Fed announcement and discussion. Big tech was mostly higher. Other outperformers included semis, banks, investment banks, insurers, credit cards, assets, financial companies did well today. Not a lot of decliners amid the very positive breadth, but relative underperformers included trucking, beverages, steel, and packaging. The dollar index was down 70 basis points today. Gold finished up 1.4%. Crude oil settled up 10 basis points. And overall, like I said, the market really saw a rebound across the board, which maybe was due to oversold conditions, but also there was some solid data today. And that could have provided some support, including softer core PCE data, declining consumer inflation expectations, something that we'll touch on more in depth later, but just to give you a highlight. November core PCE inflation rose only 10 basis points month over month versus the 20 basis point consensus, and October's pace of 30 basis points. The personal spending and income growth both came in light of the consensus as well. And from a Fed speak perspective, it was a fairly busy day. I think the highlight was New York's Williams, who said that the economy is in a great place and the baseline trajectory for the Fed still could see rates moving downward. But because of what they're seeing, they really do have time to decide. Summing up the week on the bullish side, U.S. stocks saw the biggest weekly inflows on record at $82 billion, bringing the year-to-date total to nearly $550 billion. Headline retail sales were a bit better than expected. Flash services PMIs jumped to a 38-month high in December as well, and initial claims fell 22,000 to 220,000 in the week ending December 14th, below the consensus of 230. Wasn't all good news. If you recall, Thursday was a big rout, and that was because of the hawkish Fed rate cut, with the median dot plot up 50 basis points for both the next year and 2026. Yields in the dollar also continued to move higher with the exception of today. And we did see a deterioration in breadth, right? How much of the index is doing well? The S&P 500's decliners outnumbering advancers for a record 14th straight session, as well as that stretched sentiment and positioning that we have been talking about. Looking ahead to next week, the Conference Board Consumer Confidence is out on Monday. Tuesday brings durable orders, new home sales, and the Richmond Fed manufacturing number. The market is closed for Christmas on Wednesday, so I hope you all have a wonderful time. After that, though, initial claims will hit on Thursday, while the trade balance and wholesale inventories cap off the week on Friday.
Hello, InvestTalk. I wanted to get your opinion on a company I'm looking at. It's called Leidos Holdings Incorporated. The symbol is LDOS. I wanted to get your thoughts and what would be a good entry point for it. Thanks so much. I'll be listening to your podcast.
So Leidos Holdings, Inc., ticker LDOS, is a engineering, information technology, services, and solutions company. They work for both the U.S. defense apparatus. They work for civilian operations as well. And what they generally do is they provide services for intelligence, civil, and health markets. Now, it's a mid-cap to smaller end of the large cap space company, about $19 billion market cap. It only has $5.1 billion in debt, meaning its interest coverage ratio is around 10 times. So not a lot of leverage going on here. There's a bunch of wiggle room between them having to pay their debts and the money that they are making. Their cash flow has been improving for the past 2 years, which is something that we definitely like. They don't have a lot of short interest out there. They're not issuing shares. In fact, they're buying back shares. Their shares have fallen from about 142 million shares outstanding down to about 132 million in the past 5 years. And in the past 6 months, their earnings have been consistently upgraded. Let's look at their revenue growth. About 8.7% on an annualized basis, and it has slowed down in the past 3 years, but still solid growth year over year. Its net income in that time has also grown. Get this, from 199 million last year, projected to be 1.2 billion this year. Their net margins are expanding from last year from 1.3% to 7.8%. So it looks to me like everything is headed in the correct direction. From a relative valuation perspective, they're trading at about 13.5 times forward-looking earnings, about 4.1 price to book value, about 1.2 sales. So it doesn't really look that expensive to me either. Now, they don't just have contracts with the U.S. government. They also have contracts with our European allies as well. And so as you start to see rebuilding of the aerospace and defense capabilities of European countries in the coming years, and the advancement of the U.S. defense apparatus as well, changes within the healthcare sector. The question is this company stand to benefit from that? Well, the insiders think so. There's been some recent insider buying activity from the CEO as well. And so what I'm seeing here is a company that is headed in the right direction in terms of profitability, in terms of cash flow, the lifeblood of the business. One that fits thematically with the types of companies that will do well going forward. And because of that, and because of its trading at a pretty cheap valuation relative to where it's been over the past 5 years, I actually like this company. It's only up 33, or it is up 33% year to date. It's pulled back about 7% in the past 3 months, but good company, not too expensive. That is ticker LDOS, Leidos Holdings. Looks good to me. Looks like we have our first live call. James from New York, who has a question on CVE. Do you own it, or are you looking to buy it?
I'm thinking about buying it, but I don't know. Am I looking at a value trap here? It seems to have fallen to levels. I mean, makes money, not a lot of debt. I like the sector, but I mean, what do you think?
Yeah, let's take a look at Cenovus Energy. It's an oil and natural gas company. Just pulling something else up on my other screen here. And taking a look at this company, it is a fairly large company, about $36 billion market cap. It is headquartered in Alberta, Canada. So it is part of the wide array of oil and natural gas companies to our neighbors to the north. Doesn't have a lot of short interest, pays a pretty solid dividend, but that dividend's been relatively stable over the past 5 years. You know, a lot of times when you see a value trap, you see a dividend that is way higher than it's been because the price is falling. Dividends haven't had time to adjust. So we're not seeing that here yet. Now, cash flow has improved over the past 4 years, up to about $8 billion in terms of net operating cash flow, from about $2 billion just 3 years ago. In terms of debt, it has, like you said, very little debt because it's a 26 billion US market cap company. That's about 46 Canadian dollar, but let's talk in US terms. 26 billion US dollars in terms of market cap, 7.3 billion in debt. So like you said, not a lot of debt going on. One thing I don't like is earnings have been downgraded pretty consistently over the past 6 months. But I think the big question here is, you know, what is the breakdown between, their oil segment and their natural gas segment? And I think it's more heavily oriented towards oil. Let me just check something here. Yeah, so it looks like it's a little bit more heavily oriented towards oil than towards natural gas, which is not a problem. It's still well diversified across those different things. We've been talking about it. Someone called in on, what day was that? On Wednesday, and asked, how are we looking at energy? Because this company is only down about 8% year to date, 10% over the past 3 months. And you see with a lot of other oil companies, specifically in the US, you see down in the 20s and the 30s, over the past 3 months. And the reason why is because, well, the catch up in terms of dynamics within the oil industry, the asset prices, the company prices are starting to really reflect what's actually going on in the underlying commodity. Within the US, you had that kind of irrational exuberance after the election, and it came back down to earth, and now things are really starting to match. And you don't really see that with this company here. But generally, if I'm looking towards investing in energy, we prefer and we think that over the next 4 years, natural gas is going to be a big part of it. We think that uranium is going to be a big part of it. Not to say that oil demand isn't going to continue to elevate, and it certainly will towards the end of next year. But generally, I think if I'm looking to invest in an energy company right now, what I'm looking for is one that's more tilted towards natural gas and can benefit towards some of the things that are going to be happening in the next 6 months to a year within North America. Thanks for the call. Looks like we have another live call. George from Washington State asking about.
Hi. I have a question about a company called Tripadvisor. The ticker is TRIP. There was significant consolidation, but I think the company is gonna start turning around, doing great financial moves, and I wonder if it's too early to put in, or should I wait a little bit longer?
I think Tripadvisor and Bookings.com, all these travel companies, right? People are starting to talk about them more as you expect consumer demand for travel and for holidays and experiences and bookings may start to go up next year into 2026. as the economy continues to recover and people find themselves with more disposable income. But the difference between Tripadvisor and the other companies that I mentioned is the primary source of its revenue is really from essentially a social media platform that allows people to provide user-generated content about their experiences. And although their revenue has grown consistently, it hasn't grown that much, right? 2.1% on an annualized basis going back 5 years. Grew a little bit, but again, not that much. But the key here, right, is while the revenue is growing, what about those costs? What does that net income look like? That's been falling. They had a high back in 2019 of 126 million. Then last year it was about 10 million. This year it's projected to be about 8 million. And so these margins are contracting. Their cash flow is falling. They got about 9% short interest out there. Their relative strength is headed in the wrong direction. You can see that back here, going all the way back to 2021. And so I don't think this company benefits from the same trends that other travel-focused companies would benefit from. I think their costs are just getting out of hand. I think they're not converting any of that new revenue into actual profitability, and that may hinder the company going forward. And that's why it's currently trading at about 1 times its sales. It's trading at about 10 times its forward-looking earnings. So Tripadvisor, TRIP, regardless of the merger that was announced today, going to have to pass. Thanks for the call, George. Thank you for tuning in.
If you enjoyed this content, please give us a thumbs up and subscribe for more updates.
Let's go to Grace from San Francisco, listening on AM 1220 and asking about IIPR. Do you own it or are you looking to buy it?
I own it, and there's a big drop today. I'm just wondering what your take on it.
Yeah, well, thanks for the call. Well, we also own IIPR for some of our clients. And the big drop today was as really the result of one of their largest tenants. They, I believe, account for about 17% of their revenue. Pharmacon defaulted on 6 of its 11 leases. So not all of the leases for which it owed money, but a decent portion of them, right? It was about $4.2 million. And so because of that, what you saw was a 22.74% drop in the price of IIPR. Now, even with that, its relative strength is still okay, right? It's reaching about break-even level right there relative to the S&P 500 after performing very well since 2018. Because of this drop, it's now down 26% year to date, down 45% over the past 3 months. And so what did the company do? Well, they said that they would apply their security deposits to cover the missed payments and enforce maybe some sort of contractual right under the lease in order to evict and then potentially take that property, put in a new tenant. Now with REITs, this happens, right? This happens from time to time because the business is derived from the lessees of the businesses, and sometimes they default. Oftentimes, market tends to overreact in the short term, correct itself in the medium term. Now, this is significant because this isn't some small tenant of theirs. It's a pretty big portion of their revenue. But I mean, at the same time, right, they recently declared a fourth quarter dividend of $1.9 per share. And so their dividend has still, for now, been maintained. You see a yield right now of 7.9% because of this price fall off. But I mean, funds from operation is looking pretty solid for this company. Here's what I would say, right? This isn't a normal REIT. This isn't a storage REIT. This isn't a, let's say, boring business REIT, if you will, an office REIT. This is a REIT that is predicated upon the cannabis industry. And so it carries with it different risks. And it hasn't been a particularly good time for the industry. And so understandably, one of their tenants is defaulting. And so for now, for us, we see this as a hold. We think this could be a situation where, there is more benefit to the upside than risk to the downside. Certainly, you don't like to see when tenants default this way. It does have immediate hits to companies like this, especially in a time where REITs have generally been struggling as rates try to find some sort of true direction. So for now, we're holding on to this name, and I would classify it, like I said, as a hold. Thanks for the call. Now it's Friday, and we generally make time to fit in a quick rundown of key benchmark numbers. So let me hit you with that list right now. The 2-year Treasury yield was at 4.308% today. For perspective, last week it was at 4.234. 20 weeks back it was at 3.882, and 58 weeks ago it was at 5.05. The 10-year was at 4.518 today. For perspective, last week it was at 4.395%. 16 weeks ago, it was at 3.921%. And 58 weeks back, it was at 4.63%. Gold was priced at $2,626 per ounce today. Last week, that was $2,645. 58 weeks back, it was $1,935. And 146 weeks ago, it was $1,806. Silver was at $29.55 per ounce today. Last week, it was $30.56. 44 weeks ago, it was $22.80. And 139 weeks ago, it was at $23.94. Oil was selling for $69.46 per barrel today. That is a $1.83 decrease since last week. 12 weeks back, it was $67.79. And 54 weeks ago, it was $74.30. The national average for 1 gallon of regular gasoline is $3.05, a 3-cent increase from last week. 81 weeks ago, it was $3.56, and 129 weeks back, it was $4.25. In California, it was averaging $4.31 per gallon, a 2-cent decrease from the previous week. 58 weeks ago, that number was $5.32. 134 weeks back, that was $5.87. For comparison, in Delaware, gas was averaging $2.75 per gallon today. That is $1.56 less per gallon than gas in California. Speaking of things that are expensive, let's talk about housing and why it's so expensive. And when you ask that question, the answer typically falls into one of two camps, right? One blames a constrained supply because of restrictions on land use and opposition from local residents, NIMBYs, not in my backyard, which slow down construction, while the other focuses on the demand side, specifically how low interest rates have driven up the price of all assets, including housing. But in the early 2020s, even as interest rates rose, housing prices didn't really move. So what's going on here? Enter a recent report from the Bank for International Settlements, which tried to really illuminate some of the issues around the housing market. And what they found is that the interaction between fixed housing supply and shifts in demand, where normally when interest rates drop, developers respond by building more homes, boosting construction and employment, that response has weakened over time. In the 1970s, a 1% increase in home prices triggered a 6% rise in new construction. Now, by the 2000s, that dropped to just 4%. Why? Well, tighter regulation, falling productivity in the building sector, a lot of factors. And so what's the result of that? Well, lower interest rates don't really lead to more homes. They just end up making existing homes more expensive. Now, unlike stocks and bonds, which respond pretty quickly to rate changes, the housing market moves slowly. Why? Well, you have to build homes. And in areas where construction is slower, where it lags, prices just continue to rise. Potential buyers seeing this trend may assume prices will rise even further, and that will fuel more demand and push inflation even higher in not just that sector, but other sectors like dining and travel. But higher interest rates don't really solve the problem either. So lowering doesn't solve it. Raising it doesn't solve it. As rates rise, mortgage costs go up. That makes it more expensive. It makes renting even more attractive. That increases the demand for rental property, so rents move even higher. And so the research is actually showing that tight monetary policy can actually drive prices higher. And so the rental and home buying markets don't really interact as neatly as you would like to think in your head, which for people like myself, for people like my generation, for any of you who are trying to buy a home, it makes it more difficult and life's hard enough. So what happens here? Well, renters feel the squeeze. Potential home buyers feel the squeeze. Landlords rarely sell properties to first-time buyers, meaning the limited new supply there is a limited new supply in the ownership market. And in the end, housing remains unaffordable, not because of cheap or expensive money, not because of monetary policy, but because the real issue, the core issue, is that houses are not being built. They're not being built fast enough. I looked at a chart the other day. We actually covered this in a webinar several months ago. One of the webinars we do. They're all available on our YouTube channel. And what the chart pointed out is if you look at the housing starts, if you look at building of homes, going all the way back to 2000, and there's a nice little shaded, I remember this chart very, very specifically. I like this chart. And you see little shaded areas of what are the recessionary periods. It may even go back further than the 2000s. But what you'll see is headed into 2008, things were chugging along. And if you're watching this at home, you can see my hand going up and to the right. They were chugging along. 2008 financial crisis happens, heads to the ground. And since then, we've never recovered. We have never recovered in terms of what we're building. And there's many reasons for that. A lot of it is less risk taking, either regulatorily or because companies don't want to find themselves in positions where they're over levered again. But regardless, this is the point here. Lowering rates, raising rates are not going to solve the issue here. As long as there are not homes that are being built, as long as this remains the case, neither buyers nor renters are going to find much relief. Looks like we have another live call from Sid from North Carolina. You have a question about CCL?
Yeah. Hi, Luke. Good evening and happy Friday. Thank you for taking my call. I do have a CCL in my portfolio less than 1%. And after long difficulties, it has come into some profit. I have 20% of profits. I'm just thinking, should I take those profit or maybe something more upside is left in this one? Appreciate if you can give me a more feedback on CCL. Thank you.
Yeah, of course. Let's take a look at CCL, which is Carnival Corporation. You may know them as the Carnival Cruise Line. That is CCL, Carnival Cruise Line. Make it really easy for you. And you are correct, Sid. They did struggle a lot. And the reason why they struggled a lot was, well, unsurprisingly, when a global pandemic hits, people don't really want to be on cruises. Now, today, they're up 6.43% on the back of earnings. And as you mentioned, they're really starting to show top and bottom line beats for this most recent quarter. Why? Well, booking volumes are up. Look at this revenue growth coming out of the pandemic from 1.9 billion in revenue in 2021. I don't even know how they got that, to 12 billion in 2022, 21 billion this year, projected to be 25 billion. It was 25 billion through November of this year, right? That's some pretty solid growth. Net income went from negative 74 million to 1.9 billion. Their margins obviously now positive. And now it's a $31 billion company that has quite a bit of debt, about 30 billion in debt, but a lot of that debt is pushed outward. How do I know? Well, the interest that they pay on it is such that their earnings before interest is only about 5 times the interest they're paying on their debt, meaning that a lot of it is probably lower interest rate debt pushed further out. And so even though you see a number that is resembling their market cap, it may not be as worrisome. Now, cash flow's improved, profitability's improved. We've talked about all of this. And so everything's headed in the right direction. If you look at this chart on my screen right here, you see relative strength going back to 2018 because of how bad it was during the pandemic. That's why it does not look better now, right? This is over the long term. Over a shorter term time frame, it certainly starts to look a little better. But there is a lot of short interest out there, about 6.7% short interest out there. That's a little bit worrisome for me. But you know what? That was probably before earnings came in. It was people making earnings bets. And so you said you were up 20% now. Year to date, it's up 44%. The past 3 months, it's up 41%. I think that headed into next year, right? We talked about this when a caller called about Tripadvisor. George called about Tripadvisor. And this is a good example of a company that benefits from the other side of the coin within the trip market, the actual bookings, the actual vacations, the actual holidays. And I think these types of companies stand to do better than the companies that don't really derive their revenue directly from travel, but are kind of on the ancillary aspect of it. And so I would start to take a little bit of profit, depending on how big it is in your portfolio. How big is it in your portfolio?
$500,000.
But what about in terms of percentage?
Sorry?
What percentage of your portfolio do you own CCL?
CCL, around 1%.
Yeah, I think that's perfectly fine. I think that the headwinds that this company was facing are starting to subside. You can expect that although inflation is going to probably be higher than it was in the past decade, people will be finding themselves most likely with more disposable income. At 1% of your portfolio, I don't think it's something to be concerned about in terms of it being overweight. So if you wanted to ride the momentum a little bit, but keep a tight stop loss to lock in some of those gains, I think that's perfectly reasonable. Thanks for the call. Now let's touch briefly on something that is related to the cruise lines, and that is consumer spending. U.S. consumer spending rose 40 basis points in November, really highlighting the resilience of the American economy, even as inflation remains stubbornly above the Federal Reserve's 2% target. According to the Commerce Department, spending on goods and services grew broadly, with autos, recreational items, and financial services driving much of the increase. This came after a revised 30 basis point gain in October, suggesting really continued strength in household demand. But it's also important to note that while the personal income increased 30 basis points last month and wages surged, the savings rate dipped slightly to 4.4%. And a lot of the concentration of the growth has really moved away from lower income and towards middle and higher income households, which are getting wage gain benefits, but also the benefit of owning assets. Another thing that came out, core PCE price index, the Fed's preferred measure of underlying inflation, rose just 10 basis points in November, its smallest increase in 6 months. And so there's kind of mixed signals here. And it comes at a time when the Fed is deciding what they're going to do next year. You add on top of this, Jerome Powell acknowledging the economy's strength, but also hinting that uncertainty, especially from potential policy changes under President-elect Donald Trump, could influence future decisions. Trump's plans for tax cuts, higher tariffs, and mass deportations could really fuel inflation, and all that complicates the Fed's efforts to keep prices really in check. So for now, while strong consumer demand continues to drive growth, with the economy on track to expand at a 3.1% rate in the fourth quarter, there is still issues on the horizon. Despite the positive momentum, inflation risks do remain. If the new administration's policies trigger a surge in prices, some worry the U.S. could enter a period of stagflation, a mix of slow growth and high inflation, reminiscent of what we saw in the 70s. But for now, the Fed will be watching closely. You should be watching closely. All of this affects all of us. And so investors, as the economic landscape shifts in the year ahead, must be paying attention. Stay informed with exclusive insights by subscribing to the KPP Premium newsletter today.
This is Jane from New York. I just have a question about shorting a stock versus buying puts on a stock. I know they're both bearish sentiments, but what is the fundamental difference between these two, and why would someone do one versus the other? Which one is more profitable? Which one is more risky? Just wanted to understand this more. Thank you so much. Have a great day.
That's a great question, right? Because both shorting a stock and buying a put is essentially having a bearish opinion on something, because you get profit when the stock price goes down. So what is a short? Well, a short is when you borrow shares and you sell them at the current level, right? So you sell them at $100. And your goal is you believe the stock price is going down. So at some point you have to buy it back because you're just borrowing it. You don't get to keep it forever. At some point, somebody's going to call it back, or you're going to want to close the position. And so you want to buy it back at a lower price, right? So maybe it goes down to 90, then you make $10. When you buy a put, it's an option on a stock. You're buying the right, but not the obligation to sell a stock at a set price. So if you buy a put with a strike price of $100, then you have the right to sell it at $100. So you hope the price goes down so that you can go to the market, buy it for 90 and sell it for 100. But what are the risks here? Well, if you're buying a put, say it costs you $2, what do you stand to lose, right? You're not obligated to sell the shares. So really all you stand to lose is the cost of buying the put. What about shorting? Well, if you borrowed a stock and sold it for $100, you have an obligation. At some point, you have to return those shares, which means that if the stock price goes to $1 million, you're in a lot of trouble. So your losses, your potential losses are unlimited, right? So shorting is far riskier. There's unlimited potential losses there, whereas puts, well, the losses are minimized. Another benefit is, well, with puts, you can input a lot of leverage. But the core thing here is understand the risks of what you're doing when you're trying to enact your vision of where you think a price or where you think a stock price is going. Let's keep things moving right now with a question on 401ks.
My question is about 401ks. In my 401k, as far as I know, I can withdraw penalty-free at 59.5. So my question is, if I would happen to pass away before 59.5, when does my beneficiary or my family get to access that money penalty-free? Is it when I would have been 59.5, or is it when they are 59.5, or do they not get to access it penalty-free, or what? So that's my question, and thank you. I'll listen to it on the podcast.
This is a great question, right? There are legislative and regulatory rules around what you can do with your retirement account. Now, if you happen to pass away and you have a beneficiary, your kids, your wife, your friend who's looking after your dog, well, the beneficiary can access those funds immediately. There are tax implications. Distributions from those funds are taxed as ordinary income. But what they will do is they're going to avoid that 10% early withdrawal penalty that you would have to pay if you were to draw down on this. So then what are your options for taking this money? Well, your beneficiary could take a lump sum. They could roll funds into an inherited IRA, or they could use a 10-year distribution rule for most non-spouse beneficiaries. Now, if your beneficiary is your spouse, they can roll over their 401k into their own retirement account, and they can delay those distributions. So the key here is to understand that there are different rules that apply to you versus your beneficiaries. But more importantly, there's actually different rules depending on who the beneficiary for their 401k is. Excellent question. Thanks for the call. Now, I want to remind you as we head off into the weekend that over at KPP Financial, we love to help. And so once again, I want to remind you that we can help you better understand your portfolio dynamics and calculate your investor risk number. Just go to investtalk.com and click the portfolio review button. It is a free and confidential service. And we also can help you optimize the potential of your 401ks. I'm Luke Guerrero, and this completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family members about our free podcast downloads. Get yours anytime at iTunes, Google Play, and Spotify. And while you're over there, we really appreciate it if you leave us a rate and review. Independent thinking, shared success. This is InvestTalk. Enjoy your weekend.